Hi folks, good morning. This is Dan Sheridan from Sheridan Mentoring. Today's Tuesday, April 7th, and we're in the second day of a monstrous rally here, which is encouraging to see as the little bit of hope in some of the New York cases. I think the deaths are leveling off, so the market's responding here. SPX is at 27.22, up 58 at mid-morning, and I want to look at Iron Condors today. Here's an example in SPX, and right now the VIX is 46, and I think the VIX is going to be in a range of maybe 45 to 70 over the next month and a half as things kind of go back and forth here. And here's an example of an Iron Condor in the current circumstances. Today it's interesting that SPX is up 57 and VIX is up. And you say, Dan, isn't usually VIX go down at an update? Usually, but because of the speed at which we went up yesterday and today, and then we still don't have a vaccination or a vaccine or something, so there's still going to be back and forth, so the volatility is going to stay up. There's still fear. The market's responding in response to some positive news, but it's going to be a long haul here. So if you look at this example with the SPX at 27.22, right here, I'm able to go out about 30 some days out to May 15. May 15 would be about 38 days out. And I'm able to go on the call side and sell the 30-50 calls. Again, remember, an Iron Condor is a call credit spread and a put credit spread. And you're trying, your objective is that the market stays between your shorts here. And you'll see here we got a pretty wide range here. We're selling the 30-50 calls here. About 330 points to the upside. And on the downside, we're selling the 23-10 puts. A little over 400 points on the downside. So you have a kind of a warm blanket here in the winter. A lot of room here. On the upside, we're buying the 30-60s against it. On the downside, we're buying the 2300s against it. So it's a defined risk strategy. The credit is going for about 250 right now. And so the margin, or your risk, is the difference between the strikes. These are 10 wide. So $1,000 minus 250. So your risk or margin is $750 on this trade. And I might be trying to look for maybe 10% of the margin, so make about $75. So if I sell it for $250, I buy it back for $1.75. But on the other hand, if it went against me, without getting into adjustments and stuff, I would have a max loss. If this went against me, like 10%, if this went against me 10%, if this $2.50 credit went over 325, I just buy it back in. Now, we don't have time to get into some of the adjustments and stuff, but that's a very basic risk management plan. But what I wanted to talk about just for a second is, if we're bringing in a 250 credit, one of the ways that I like to trade Iron Condors in a real volatile market, because we're up big, down big, if, let's assume here 250 credit, and let's just assume the call side was maybe $1.25 and the put side $1.25. And so how do you trade them? Do I just wait till, if I sell it for 250, wait till I can buy it back at 175 and get out and make 10%, or when I hit a max loss and it goes to 325? Well, one of the things in a volatile market that's interesting is that when these credit spreads, everybody can say, oh, when a credit spread gets to 10 cents, I'll buy it back in. But in a volatile market, if these credit spreads, individual credit spreads, let's say we go up, and this is your call credit spread and this is your put. If we go up and I can buy the puts credit spread at even 60% of what I sold it for. So 60% of $1.25 would be about 70 cents or something, somewhere around there. I'm just doing the math quickly in my head, which could be dangerous. So meaning if I could buy it back at 50 cents, 50 or 60 cents, I would do that because the market's going up, it will go down. And so it's key that we keep it. I always say in shared mentoring, we keep a clean kitchen. We'll buy these things back. Not just when they go to 5 cents, because they're whipping around, just so I don't have to stay in them long. This is a 30-some day, 37-day trade. I don't want to stay in it that long, maybe a couple weeks. So how can I get out in a couple weeks? By taking off these credit spreads, taking off the put credit spread on an up day, taking off the call credit spread on a down day. Anyways, if you like this discussion on Iron Condors, we check out the Shared Mentoring site. We just did an Iron Condor in a volatile environment, volatile market series, and we did it last Saturday. I'm actually doing a follow-up on it this week, but you can get that archived on Shared Mentoring, and then the last webinar in this series on volatile markets is going to be this Saturday, day after Good Friday, and that'll be on back spreads. And these are all hedge strategies that we're using in Shared Mentoring during this volatile period. So thanks everybody, appreciate your time. Thanks a lot.